What is going on? Welcome back to the Paper Gain Show. I'm Johnathan Rankin, joined by my co-host Matt Magee. Matt, what is going on?
Not much. How are you?
I'm doing great. This is the show for those who have $1 to $10 million. And today we're going to be covering how do you manage risk versus reward. It's the tale as old as time when it comes to investing. But what we always find is that in bull markets, everybody forgets what risk is, and everybody gets that harsh reminder when we start seeing a pullback. So today we're going to talk about how do you balance that the right way, especially for those that are in that $1 to $10 million bracket, because it really starts to hit home and become that much more important in this segment. And we'll dive deeper into why that makes sense for this segment alone. But Matt, let's kick it off. Let's start talking about that balance between risk and reward, and how do you frame that with clients?
Yeah, I think first the easy thing is obviously your risk tolerance. A lot of people, I mean, you can Google risk tolerance questionnaires. That's easy to find. I would say to give us a framework and kind of set the stage for today's conversation, it's important to understand like your risk tolerance, your capacity to take that risk, and the need to take that risk. Like, do you, if you have $1 billion, like you probably don't need to take that much risk. But as we're talking about those with 1 to 10 million, it's very important to understand the need for risk as well. But I'd love to hear.
Yeah, and part of the reason why I think this segment of that 1 to 10 million is really important is because when you start going through the loss side of it, so not necessarily the gain, but the loss side of it, those numbers get to the point where they become real and they become really realistic in the terms of people's mindset. Because most people who have between 1 and 10 million, my guess is that they're not the people that are making $1 to $2 million a year. They probably were making a pretty healthy income and maybe had some sort of liquidity event, or were just really good savers for a very long period of time with a healthy income. But if, let's say, you have $5 million and you take a 20% haircut, that's $1 million.
Yeah.
And so what happens is, when you have that on a paper statement loss that shows $1 million lost, what goes into people's mind, especially in this category, is that was 5 years of income. That was 4 or 5 years. That might have been 7 to 10 years worth of working hours that I put in to earn that, and that's just gone like that. And that's the reason why most people don't think about like that in an up market. In a bull market, everybody's thinking, hey, let's make money. Everybody's having fun. It's the opposite when it starts coming down to that was 4 years of salary right there. And that's why I think this segment is really important to start that conversation about what is risk, because yes, everybody can look for a risk tolerance questionnaire or work with an advisor on those conversations, but those questionnaires, they only go so deep because, like I said, nobody remembers risk in a bull market. Right now, I would say that, I don't know about you and the conversations you're having, but it's not necessarily about, hey, let's worry about our how concentrated we are. Let's worry about this or that. I mean, the VIX is at, record lows right now, and I think everybody is complacent with what we've seen in the market. So it's the reminders that risk tolerance is needed when we see volatility.
Yeah, couldn't agree more. And as you know, most clients have never even heard of the VIX, so that they just, to your example of that $5 million client that loses $1 million, they don't care if it's 20% or 25. They know the dollar amount. That's something
Mm-hmm.
I 100% learned in 2022 when had a doctor client, sold his practice, had some commercial real estate, but he was no longer making a high income, so that's gone. And go into the meeting and around this time, August, September, which, if you remember, the market started to rebound, I think, in October, November. So it was a
Yeah.
month or two before that. And he was pretty conservatively invested, call it a traditional 60-40, but bonds got hit hard that year. And he knew even before we showed him the reports that he was down $2 million on
Yeah.
a $10 million portfolio. And so having to kind of address that risk tolerance of why you're continuing to take risk, showing um, the gains over time, that this is just a short period of time, and that to meet his consumption needs over a long period of time, this is why you're invested in equities, and kind of being able to walk somebody through that. And then you can get into more tactical things like tax loss harvesting and other things that we've talked about before and will continue to talk about. But at a very high level, kind of walking somebody through, like, this is what we agreed to. This is why we're doing it. You have the capacity. You've got, I call it a year or two in cash. That was something that we didn't manage. Uh, there's the need, and usually people get much more comfortable once they feel like, one, you know what you're doing, and two, that they're doing this for a reason, and that this is short lived.
Yeah, but at the same time, there's it's always the counter to that is that person who, they have to understand that if we're going to reduce the risk on the downside, that means that we're probably not going to be up what the S&P's up in the
Yeah,
up markets.
exactly.
And that's the trade-off, because that's it's always benchmarking to whatever the benchmark is. Now it's the S&P. I remember years ago, I'd have people say, well, the Dow's up X, and you're going, the Dow, like the people's index? That No, that is, who's using the Dow as a reference? But you can pick your benchmark. And I think that's part of the reason why it was always a challenge to have, for the 10 years plus that international underperformed the US markets. It was always tough to have international in a portfolio, because every time you grab your phone and it's like, who the first thing you look at on the stock screen is S&P, Nasdaq, Dow. My guess is that nobody's looking at what the Nikkei is doing, or the Euro stocks. It's just not front of mind. And so it's thinking about how you are as an individual investor. Are you the type that is going to be frustrated if your portfolio is not doing what the S&P is? Because that's pretty simple. Then just
Yeah.
let's do what the index is doing.
Yeah.
In having those conversations in both up and down markets as to, what is my benchmark? If I'm the advisor and you're the client, what are you grading me against? Because that's also part of it. And because then, the client also has to articulate, what are you grading yourself against? Because are you going to compare, let's say you've got a 401k that's in a target date fund. Are you really going to compare that to the S&P 500?
Yeah.
My guess is probably not. And so it's having those conversations in both markets, in up and down, and going through that dialogue of, okay, if the market's down 20%, are you okay if would you be happy if you're down 10, and starting to really think through that part of it, because that's where I find that risk reward conversation is best had, is making sure you go through those things and really understand what the benchmark is, because benchmarks can change a lot. If people, if I said, hey, look, I want to benchmark my physique to, an Olympic power lifter, you'd go, well, you don't lift like that and you don't eat like that. So why would you benchmark yourself to that? And so it's just, it's finding the appropriate benchmarks, because you can feel inadequate, or that your portfolio is not doing what it's supposed to be doing if you're comparing it to the wrong thing. Like,
Yeah.
I could be healthy, eating the right way, doing all of my, workouts the right way, but if I don't look and feel like a power lifter, well, then I'm comparing myself to the wrong thing. It's the same thing with investing. And so,
Yeah.
that's a big part of it. But
Are you
what
seeing clients that want to beat the S&P? Like, I mean, I guess a lot of the client conversations I'm having, even for younger clients, maybe they're not directly saying that, but like, we're trying to okay, how much risk tolerance? If they say I don't know, then that's a different discussion. But most people say, hey, I'm moderately aggressive. Uh, then you build out an allocation around that, and you walk them through kind of here's what to expect.
Yeah.
And then I guess what I'm saying is I haven't had too many actual clients say, "Hey, the S&P 500's up 12% this year. We're only up 10%. What's going on?" I was just curious if
I
you're
think I think no matter what, and in the history of my career, clients always want more in
uh,
markets like right now.
yeah,
It's where, why don't we have more Nvidia? Why don't we have more of X? Why are we not doing this? And it's always remembered a little, years after the fact. I remember
in
in
good years,
2021.
not
Yeah.
bad years.
So, for example, 2021 was one of those years where, kind of similar to right now, it was high concentration to a few names. Tech was leading, and it was just everything was, going gangbusters. And then, it was the same conversations of, risk management. This is why we have a balanced portfolio, why we have asset allocation. 2022 was I had a pretty good year that year, and that was a year where, it was, this is why we invest the way we invest,
Yeah,
is because you have that balance. That balance provides, a ballast during times like this. Now, it gives you that chance during that down market to really reset and go, okay, how'd you feel when the market was at all-time highs and we weren't getting 100% of that? Were you okay with that? Or because now that the market's, going through this sell-off and we've protected on the downside, we can always add more risk. It's like the inverse to a haircut. Like they can't, once they cut the hair, they can't keep, they can't put it back on. It's the same type of thing. We can always add risk after the fact, but
yeah,
if you were risky to begin with, we can't do anything during a down market.
yeah.
And so
I
it's just having those are the conversations I always have. I had them a lot in April
yeah.
of this year during the tariff issue, which was, hey, how'd you feel then? How do you feel now? And do we want to make any changes? I specifically had this. I remember one client, they were heavy in crypto as well, and that obviously took a hit. So it was when everything had recovered, we had a review, and the conversation was, how do you feel now about what we just went through? Because now that things are recovered, were you okay during that time? Obviously no financial changes were made during that time, so that was the positive that came from it. But feeling wise, did you feel like you were going to? Do you want to change anything about that feeling? Let's have that conversation now once things have recovered. Right now is probably the best time, if ever, to have that risk conversation because
Yeah, it's
things are at,
yeah, and the
yeah,
market's recovered. It's top of mind. You can remember what it was like in just a couple
yeah.
months ago in March and April. Yeah, I like that. Any other tactical moves besides rebalancing, tax loss harvesting, charitable giving, anything else, or good client stories as it
Yeah.
relates to kind of managing risk?
Yeah, I think there's usually one. Gotta love when my light turns off here. There's always one that comes to mind, and that's when you run when you do some retirement planning and financial planning, and you get to the point where you've got all of your needs met. So let's just say that we run the plan, and it's going to cost $2.5 million to live the rest of your life and not have to worry about money. But then there's excess left over. And there's this conversation where there's this fork in the road where you can say, all right, do you want to be balanced and continue this balance, knowing that we're playing it safe, but you're never going to touch all this money either way? The other side is, do you invest it for your legacy and for your kids and your grandkids? And there's that shift in mindset that has to happen where it's the thought of the time horizon now just got changed. If let's say you're 65 years old and you've got $5 million, but we know we can run all the calculations that you would be completely fine if you just had 2.5 million. So we can isolate that 2.5 million into a balanced portfolio that's going to provide all the lifetime needs. But what about that other 2.5 million? Do you play that safe, or do you think, okay, now my time horizon's my grandkids' time horizon? And so if you were to invest for your grandkids, would you invest in any balance? Would you invest in fixed income? Or would you just invest for long-term growth? And that's a conversation I've had a lot lately with clients, because, with the market at all-time highs, obviously asset prices are at all-time highs, and, clients' lifestyles, for the most part, they go up moderately, but most clients, if their portfolio is up, let's say 10, and their lifestyle is not going to go up 10%,
No.
and so there's this point where, because of the strong market we've had over the recent years, the market's here, lifestyle's here. So you have this thought of, what are we investing for? And then how can you have almost two different risk tolerances? And how can, and working through that with clients to help them understand, okay, in this bucket, this is going to be for you to live off of for the rest of your life. So yes, we want to be moderate there. We want to make sure that we're managing risk. But for this other bucket here that you're never going to touch, it's going to be all gas. Let's go. And so, but when the down market hits, we've got to remember that was for the grandkids. That's not for you. Yours is going to be, managed this way. So that's one thing that I've had a lot of conversations with lately. And I tell clients, that's a family decision. That's between the family to determine, do we kind of play it safe and just make sure that we're good and whatever's left over goes to the kids, or do we actually invest for legacy capital and lifetime legacy for our grandkids? And we can't tell a client what to do. I can say, look, these are your two options, but they ultimately have to have that conversation with their household to determine, are you okay with that? But that's a conversation I've had, I would say, at least a few times per week of that legacy call. And I would say it's probably 55% will choose that, hey, let's invest it for the long-term grandkids. But I would say 45% of people are saying, I want to make sure I'm good first.
Yeah.
And I think a lot of that is because of that $1 to $10 million bucket, where it's a lot of those people, they earned this money. It wasn't just gifted to them. They worked really hard for it. So they want to make sure that that they're taken care of. And it's not like because it wasn't handed to them, they're not so focused on handing it to the next generation. So I think that's a big part of it too.
Yeah, that's interesting to hear kind of what the breakdown is. I guess I've had those conversations as well. I'm trying to think back if it was a similar breakdown of, call it 55-45. But yeah, I think a lot of that depends on age, health, all of that comes into it. If somebody's healthy and 65 years old, it's kind of, which we'll get into in future episodes, is around estate planning and the whole thing of giving away assets and giving away control. That's for a separate episode. But any other things that you've seen, common pitfalls, or something that you'd want the viewer to take away from the conversation today?
Yeah, my biggest takeaway, the number one takeaway, is the fact that risk is real. It may not feel like it right now. And everybody's got a very short memory. I mean, I think I've mentioned this in previous episodes. You got to remember, we did go through COVID. There was a period where we couldn't be around each other. We were all sitting around in masks, just, staying 6 feet away from each other. That happened, but we all kind of buried that deep. We all kind of buried 2008 real deep. I know I did. We all, 2022 felt like a decade ago.
Yeah.
April feels like it didn't happen. And so risk is real. And you want to make sure you're having those conversations now, because the market's near all-time highs or at all-time highs, depending on where we're at today. But you'd rather do something when the market's at the top. The most conversations that I have with people after the market's fallen are, I wish I would have done something. Yeah. So now's your opportunity. This is the calling. This is the warning shot. I'm not saying the market's falling tomorrow, but we know that volatility is going to come back at some point. So this is a time to think about it again. Remember it's real, and put yourself back into those times and think, do I want to do anything different? And so that's just one thing to think about. It's the only thing I want people to take away.
Uh, I like that. That's a great one-liner, and I would add one thing to it. Risk is real. Completely agree. And there's many different types of it. I mean, there's cybersecurity risk, not to fearmonger or anything like that, but you just see in this business all. Sometimes you see the best and the worst outcomes, and so I like your positive kind of ending note to have those conversations now. So, all right,
Absolutely.
appreciate
Well,
it, and we'll do it again soon.
yep. Make sure you hit that subscribe button and follow us along. And we love getting these episodes out there and these conversations just to get your brain thinking about different items. So do us a favor, follow along, and we'll see you next time.